Good morning, folks. I do believe it's been a slightly better week than the previous few weeks that we've experienced. I think the sentiment is a little better because of US trying to come around and mend its ways. At least that's what we think, going by the media reports. The number of tweets from the US president saying, hey, we are great friends, to Modi and so on and so forth, and Modi reciprocating in a similar but very calm, cool fashion. I think there's a greater optimism that things will get sorted out, and the equity markets also seem to be feeling the same way, the way they've been a slight bit of a rally there in the market, right? So what have we got for you this week? It's a varied basket, okay? So I'll be looking at what's happening to the changing consumption patterns in India. We'll be looking at in-phase buyback plan and what it means. And we'll be going with what inflation is saying in India, okay? And subsequently what inflation is saying in the US too, the other large economy. And some interesting transformations that are happening in Saudi Arabia as regards oil. We'll be looking at how gold has been working its way through and how it's been impacting global reserves once more. Some interesting stuff about unclaimed assets lying in accounts. And what is it that those in the 30s really have to do? Manage savings or manage expenses? So we look at these few items today. So let's go into the first part, okay? So actually this article in Mint was about how Temasek is looking to buy a large part of a snack food maker by name Balaji Foods, okay? Not many have heard of it, but actually it's being valued at almost 38 to 40,000 crores. It has a 5,500 crore turnover and a 550 crore odd profit after tax. So, and why is Temasek suddenly looking at buying? Obviously, apparently a lot of private equity companies have been looking at the snack food market, and especially the premium snack food market in India, and buying into it. But in this light, a very interesting tidbit came in, okay? So in around 2000, okay, hardly, that's not too many years back in the scale of things, Indians spent almost 40% on cereals and pulses, okay, across their household spending, I mean to say, and another 15% on salt, sugar, oil, spices. That's about 55 to 60% on what I would call staples. And packaged foods formed hardly 10%, struggling to form 10% of the household spending bucket. Guess what? Fast forward to now, and packaged foods is more than almost 25% of the spending basket of household, okay? And that has come at the expense of cereals and pulses, of course, which has fallen to less than 10% of the total spending basket, okay? What has gone up is packaged foods. What has gone up is fruits, nuts, and vegetables, okay? And the rest of them more or less the same. Of course, cereals and pulses has come down. Interesting trend. One observation that comes to mind immediately is if we are spending so much more on packaged foods, our health is definitely going for a toss, okay? And this is happening across the world, but I think we have to be far more conscious in what we consume. Unfortunately, more of our money is going there. And if this continues, you'll also see more of our money going towards healthcare, which is an obvious fallout as we will switch forward another 25 years from now, okay? All these last few podcasts, we've been speaking about how urban consumption was weak and now it is just picking up. And these seem to be contrasting, right? We are saying urban consumption was slowing down. At the same time, we see that the spend on packaged foods and premium packaged foods has gone up so much. So what's happening? It seems to be a contradiction. So it does seem that much of the growth in consumption of foods is coming in from the premium segment. That has accounted for almost half the growth. And it does mean that people are spending more on this than other items. That's the only way one can explain it. Okay, and this is a fast growing segment of it, expected to grow at almost 37%, and hence all private equity companies are looking at getting a slice of this pie. Let's see what happens. I just hope we keep our heads and consume less of packaged foods and more of healthy food. So you saw people were spending more on fruits and nuts and vegetables too. Okay, and I just wish they spend more on that than packaged foods. Okay. There was a wonderful announcement from Infosys, and they have announced a buyback of their own shares to the extent of up to 18,000 crores. Okay, and this 18,000 crores that will be spent, they are willing to buy it at almost a 20% premium to the stock price today, which shows that the management believes that their stock price is undervalued, and they would rather buy it back for the company at this price. Okay. It's a confidence building initiative, and they're also saying that they would want to commit 85% of their cash flows to be returned to the investor, either in the form of buybacks or dividends. Yeah, nice. Companies are giving the profits back to the shareholders. It also means that growth opportunities are reducing quickly. The company is generating this cash and they don't need to deploy it in their own assets or expansion. So all very clear signs that growth is plateauing out. So yes, if it's going to be a cash cow, that means growth is plateauing out. Need not be in fee. The entire large IT outsourcing industry is facing the same. And if you look at any such business where they want to give back most of the money to the shareholder, it means the company doesn't know what to do with the money. There are no growth opportunities available for them. So that is what. The other thing about this share buyback, which I want to bring to your attention, is that it will all be taxed as capital gains in the hands of the investor. Okay. Earlier, the company had to pay a tax on buybacks. Now the entire burden is shifted to the retail investor. Why retail? Mutual funds are anyway not taxed. So, and FIIs have their own treaties on capital gains. So it is the small retail investor, poor guy, is going to be paying the bulk of the tax in this case. Okay. So that is it. And then we move on to what's happening to gold reserves. Okay, and it does seem that even the last few months, a lot of countries have been ramping up their acquisition of gold, and this is in the order of like 40% more than the previous year. Countries have been led by Germany, then France, and China, India, all have the change in their gold reserves are like 41, 42, and in the case of India, 47%. So that goes to say a lot about the confidence in the US dollar. So do you know that today, if you're taking the aggregate of global forex reserves, for the first time ever, the proportion of gold is more than what is occupied by US treasuries. So central banks as an aggregate, global central banks as an aggregate, own more gold than US treasuries. And as a proportion of total reserves, gold is now 25% of total reserves. At the expense of what? US treasuries. Okay, it's grown from an insignificant number to 25%. So this is what the world seems to be thinking about the US dollar and US treasuries, less and less confidence in what's happening there. An interesting tidbit, okay. The headline reads very interesting, by the way. It says, oil giant Saudi Arabia is emerging as a solar power. I mean, did you ever think you'd be reading headlines like this? Saudi, the one who's always seen as the oil producer with the largest reserves of oil, etc. Okay, of course, the largest reserves of oil are in the US and Russia, but Saudi was always seen to be as the place where you get your crude oil from. And they're the ones now becoming a large producer of solar powered energy. Okay, the aim is to have about 100 gigawatts of solar energy. And look at the reasoning. They figure that with the lower cost of producing solar power, okay, so China is the largest exporter of these photovoltaic modules, and since they have been producing in such scale, the price of it has come down to such an extent that Saudi finds it cheaper to import these photovoltaic modules from China, produce solar power, and not consume as much crude oil for itself. They'd rather sell that crude oil to other countries and use cheaper photovoltaic solar power for themselves. How do you like that? Okay, and by some counts, they're going to save about $20 billion. So for their own consumption, they'll use solar power, and for the rest of the world, they'll export their oil. Okay, great. Times are seriously changing. Okay. And further in the newspaper, Dhirendra Kumar is reminding us that the aggregate of unclaimed assets in various places is now 1 lakh crores, whether it is EPFs or PFs or unclaimed shares, unclaimed dividends, unclaimed fixed deposits, all together is like 1 lakh crores. He says, guys, please spend less time on tracking markets and spend more time in trying to reclaim your assets. Spend more time in protecting what you have. Get your KYCs updated, get your nominations updated, get your wills updated. That's the only way you can at least keep what was already yours, rather than let it lie around in these unclaimed accounts, which will eventually go away to some investor protection fund or some such thing. Okay. Yes, it is very difficult, in his own words, to reclaim these assets, and which is why many people just give it up. So don't get into that stage at all. Do this basic hygiene check continuously, or if you don't know how, take the help of a financial advisor and do it, and don't let your wealth add on to this 1 lakh crores of unclaimed assets which is there. Okay, so here we have a couple of economists saying that inflation seems to be headed for a new normal that is lower. We have been seeing that inflation in India has been constantly coming down. Okay, and in fact, headline inflation rose just 0.9% month on month in July, compared to an average of 2.2% during the same month in the last 2 years. So inflation is clearly headed down, and both consumer price inflation and wholesale. In fact, wholesale price inflation even went negative the last couple of months. Okay, so why is this happening? So what they're saying, they're both cyclical factors and structural factors. Okay, so global commodity prices have been falling, and oil, which is a large input to the inflation basket, oil has been falling in price. Okay, and India has been managing its food production better. So food production and food storage, etc. So good rains have been helping and giving us better food grain production, and that has brought down the prices. That can be cyclical, but structurally the way food is stored and prices are being managed well, whereas where required this is allowed to be exported, where required food is being imported. In totality, we are keeping the food prices under control. Okay. Secondly, the way food is being stored so that less of it is getting wasted. Logistics is improving, bringing down the cost of transport of food grains from place to place. So all this is helping keep food prices low. One more thing, even productivity of food is going, agricultural productivity is going up. So these are structural factors, productivity, logistics, storage, all these are structural factors. Cyclical factors is what can reverse. Okay, like global commodity prices currently is down. With global economies picking up sometime in the future, this can go up again. Okay, but we are doing a lot to keep inflation down, which also means that if inflation remains at these kind of levels, doesn't it mean that there's a greater scope for the Reserve Bank of India to cut interest rates? So there are two camps, as always. Okay, one camp says structurally inflation is heading lower, so we can bring down interest rates further, and the other camp says, hey, I don't know how much more the government has to borrow because of the GST reduction and the income tax reduction, etc., etc. But by all accounts, the consensus seems to be that the government doesn't have to borrow much more to fund this GST reduction. Much of it will be made up by higher consumption. Okay, so it seems to be tilted in favor of those who are saying that there should be a greater room for interest rate reduction. Let's see what happens as far as that. And if you're in sufficiently invested in long bonds, yes, you're going to benefit from this. Okay, so we are at a time where corporate bond yields will be inching up. Okay, so it'll be good to be in corporate bonds. And as and when interest rate cuts happen, you'll also find capital gains on your long bonds and you'll make a greater return. So yields are generally looking good. We should not be ignoring fixed income at these kind of yields and this kind of a scenario. Okay, so that's about here. And then what's happening to global funds? So China has done well. Hang Seng has done very well. US markets have done well. In fact, these markets have done far better than India over the last 12 months. Again, a reminder, folks, please diversify your basket of equities to beyond India. And remember, there's a world outside US. Don't think international diversification is just about buying the NASDAQ or S&P 500. No, please. There are a whole lot of things happening elsewhere. Emerging markets, China, Europe. Please diversify and have some wealth in these places also. Okay, and a lot of ETF flows have been happening into China and Europe and EM funds in the last place. So what's happening with the US dollar? The dollar has been depreciating. What's happened to the US treasury yields? So last week there was a panic that the 30-year US treasury was touching 5%, which it hasn't seen for a long time. And I was telling you this was along with what's happening in UK, France, and Japan, where yields were shooting up, okay, because of worries on the fiscal side. It has so transpired that over the last 1 week, a lot of revisions have taken place in the US on how many jobs are actually getting lost. It turns out that the US department in charge of all these statistics has been horribly inefficient, and they've been showing a very different picture over the last 1 year. Job losses have been far more serious than what it has been made out to be, and it's all coming to light now. And given the seriousness of job losses that the Bureau of Statistics is now putting out, I think the Fed will have to take cognizance of this and cut interest rates. We've been saying all along that unemployment is all right. I mean, it's going on, but inflation is a bigger worry for them. Now, given this extent of unemployment, I think that is a bigger worry, and the US Fed will have to actually cut rates, and regardless of inflation going up. So the initial part of it, they said inflation is under control. The latest monthly data shows that inflation has been inching up, maybe because of the impact of tariffs. We don't know yet. We will see over time. I think we are getting some good data on this coming up in a upcoming Take 5 issue. Watch out for the next Take 5 issue to throw some light on this. Okay, but because of the bets that the US Fed will cut rates, treasury yields fell, US dollar fell, gold went up. This is just standard relation. Okay, if a dollar weakens, if interest rates weaken, gold will strengthen. That's exactly what's been happening. Gold and silver have been strengthening, and that is what is happening there. Then we come to an interesting part more on personal finance, right? Which I've been telling you. There's a huge article here in the Mint, how to turn your 30s into a key wealth building decade. I have absolutely no argument against this. It is important that you start early and grow more wealth, because that is simply what time and compounding say. Give more time, the compounding is higher, and if you start saving early, that in your 30s you are going to make more wealth, clearly. But I think the challenge is not on this. The challenge really for somebody in their 30s is not managing wealth, but managing expenditure. Okay, so this entire article speaks about how to build your mutual fund buckets, but I'm saying, hey guys, hold on. Somebody please teach them on how to save first, manage expenses. Most youngsters look at the equation like this: income minus expense equals savings. Okay, but that's a very passive way of doing it. The active way of doing it is income minus savings equals expense. Fix on your savings target first, and only what is left over can be spent. And the challenge here is youngsters like to spend. They like to experience all the good things in life early on than later on. Instant gratification plays a large role, which is why managing expenses as a focus is more important than telling them how to invest. Okay, so that is my take on how to manage for the 30s. So that's all for this week, folks. Have a good weekend ahead. Good day.